Now, it has actually been some time since I last spoke about Grab, and in my previous couple of videos regarding this company, I spoke about the environment that they are operating in, some of the opportunities and risks that are in front of Grab, being a company that operates within the Southeast Asian region, right? And I think for us as investors, it is important to understand that Grab is basically a business with three primary growth drivers, which we are going to explore. But today we are going to do something slightly different. We are going to be looking at the business through the lens of management to track the metrics that the management are tracking for the business and use that to build out a valuation for Grab in the same way that we have done for HIMS and SoFi. And so with that, let's dive in. And I think by now you should be pretty familiar with Grab's business model. If not, I'm going to be leaving a link to the previous video down below as well as up above, and you can feel free to watch it after this video. But to understand Grab, at least on the high level, you have to understand that they have three main verticals of their business, and the biggest two being deliveries as well as mobility. Now, mobility is basically another name for their ride-hailing services. And both of these metrics within their business is measured by something called the on-demand GMV, or gross merchandise value. And so what you are actually seeing, I'm showing you the wrong graph. What you're seeing over here is actually their Q2 numbers, and the GMV that I'm talking about is shown in the middle. And their Q2 numbers were actually pretty good, but we'll get into that and dive deeper into the numbers a little bit later on. But these businesses by themselves, the delivery services as well as the ride-hailing services, should not need too much explanation. It's quite a basic business that we should know by now. But the one thing that we really need to pay attention to when it comes to Grab and how they have built out their delivery services and their ecosystem of drivers is really how they have made use of incentives to scale their business. So if you take a look at this graph with me over here, the blue bars represent the growth of on-demand GMV over the last couple of years since 2021 all the way until 2025. But what is interesting over here is this orange line that we see. Now, this orange line, you can see a huge spike in the early part of the 2020s, in the 2021, 2022 period, where Grab was really building out their ecosystem of drivers. And when doing so, they chose to incentivize both their drivers as well as the consumers very aggressively to come onto their platform. And that is where we see a spike of in incentives. Now, however, if you take a look, the amount of incentives that are being handed out has kind of moderated over the more recent quarters, and this has stayed pretty much close to the 10% range over the last 8 quarters. And I think this is a level that is a lot more sustainable for the long term. Now, I think why this is actually bullish is that, when you consider how Grab is building out their ecosystem, it means that it's going to be very hard for another competitor to come in and offer a similar level of incentives in order to pull the drivers away into their platform. And so because of that, this has become a moat for Grab. Especially as Grab becomes bigger and bigger, they do not need to increase the percentage of GMV that they spend on incentives to be able to offer, incentives that are better than their competitors for the drivers. And that is where Grab really has a competitive advantage in the Southeast Asian region. And yeah, so basically, as they're able to keep their incentives as a percentage of GMV steady at around the 10% range, and at the same time still able to grow their GMV significantly, then I think we can see there's no need for them to increase the amount or the percentage of GMV being spent on incentives unless they really want to go after market share once again, or if they feel like there's someone else challenging their market share. And I think to me, the most bullish aspect of understanding the relationship between the incentives that Grab gives out as well as the growth of their GMV is that over the last 2 years, even as they have moderated the amount of incentives being given out to both drivers and consumers, what they're actually seeing is that their GMV continues to grow, which means that both the drivers as well as the consumers do see value in their platform, in that ecosystem. And because of that, even with the moderated incentives, people are still using their platform more and more every single day. And so Grab is really a kind of company that is constantly finding new ways to expand their business verticals. And you can see that through, Grab delivery advertising. They don't just focus on delivering food and groceries. As they move into this advertising space, you can actually see it actually perform very well, right? So advertising revenue in this segment, I believe, grew around 45% year over year and hit an annual run rate of $236 million, right? So this to me is actually quite impressive that they have actually managed to use their delivery segment and to actually run an ad campaign over it and basically find another way of generating revenue through their food delivery segment. And so over time, a relatively simple business of delivery has become a virtuous cycle, because as the company's delivery GMV rises, this becomes an increased opportunity for advertisers to advertise on their platform. And I think because Grab will be able to have all these data over the consumer's purchasing behavior and things like that, they are able to offer advertisers a more targeted advertising space, and therefore it's easier for them to monetize the advertisers on their platform. Therefore, over time, a relatively simple business of just delivery has become a virtuous cycle for the company, because as the delivery GMV rises, what happens is that it translates into increased opportunity for advertisements that can be monetized. And so on top of that, right, Grab also, you have to bear in mind that they have the data of consumers' purchasing behavior, and as they sell that to advertisers, it allows them to better monetize the advertisers that are using their platform, because the advertisers will be willing to pay more for these kind of more targeted advertisements. So, like I said, despite all the nice growth that they have reported so far, it's important to remember that this is still a fairly small segment of entire business, which has the potential to grow. But like I said, nothing is certain in this competitive Southeast Asian landscape. And then from here, I really want to focus on what I would consider to be the lifeblood of their entire business, which is, the users that are on Grab's platform. Now, Grab offers a subscription service known as Grab Unlimited. And basically, what it does, I'm going to show you. It's over here. Grab Unlimited is something that gives its users extra savings on rides as well as on delivery fees, just for a small subscription fee of around $6 every month. Right, so I'm going to show you, before I dive into what the management has said about this app during the earnings call, I'm just going to show you how the inside of this app looks. So you can see over here, if you're ordering food, of course, you can choose, between priority delivery, standard, as well as order for later. And the total here ends up to be $20.40. Now, out of this $20.40, if you look at the next page, because I chose the option to have the food delivered to my place, I can get up to $3 off of the delivery fee. Of course, there's a minimum spend of $15, right? That is actually not too hard to hit nowadays, seeing how price of food has actually increased. And so with that, what it means is that you're paying $6 to subscribe to Grab Unlimited, and within two orders, right? Within two orders, you actually make back the entirety of your subscription fee. And so the grayed out portion that you're seeing at the bottom is basically if you actually choose to do a self pickup instead of delivering the food, which means that you order in advance for the restaurant from the cafe, and then if you choose to walk over to pick up the food because it is near your place, you can actually save a bigger percentage of your entire bill. So you can see, for me at least, because right now it is nearly midnight, and because of that, the delivery fees are much higher. That's why you can see $9 and $6 in the first picture over here. But like I said, during the day, this can be nearly amounting up to a free delivery if you get $3 off. So over here, basically what you notice is that you have 90 over coupons. I'm not too sure if you can see it or if it's very clear. I've already used 2 coupons this month. So there's 97 coupons left, which is why you see this 97 in orange over here. But in actual fact, there's basically 99 coupons that you can use each time to offset $3 of your delivery fee, right? And so because of this, because of all these perks, you can actually see over here during the earnings call, the management have actually told us that they're seeing an increased adoption of their Grab Unlimited plan. It's not just the monthly plan, but actually the year-long 12-month plan, right? So basically 42% of all Grab members are now on the 12-month long-term plans. And so the difference between the plans is that if you're going on the month-by-month plan, I think you pay $6 per month or $5.99 per month every single month for 12 months. However, if you go with the 12-month long plan, I believe this is $60 a year, right? So it's a bit like Amazon Prime. The cost of the membership is really so little that people just keep it rolling, and once you're subscribed, you don't tend to unsubscribe just because of a $5 to $6, based on the convenience that you have, based on the fact that within 2 orders you can actually make back your membership fee. And so because of that, this makes the entire product very, very sticky. And so after this, I think the last aspect of Grab's business is really their financial services side of the business. And this is the aspect of their business where I feel like I have a little bit of a pet peeve with, because like I said before, I think, to be very frank, I am concerned about who they have chosen to partner with in this venture. As a consumer, I don't really like Singtel, which is the partner company. They're not even a financial services company, so I'm not too sure. I didn't really read into how these two companies ended up together, Grab and Singtel, because Singtel basically runs a telco business. And at least, I mean, feel free to correct me, but I believe in Singapore in the past, they have been known to include a lot of hidden fees within their phone plans. And then when you want to call them to take out some of these hidden fees, they have pretty terrible customer service. And on top of that, I don't think anybody sees Singtel, at least from a consumer POV, that they are a very innovative company. So with that, I think one of the pet peeves, like I said, I have with Grab and their whole financial services platform is that up to today, you can see this was a question asked in September of 2024, just 1 year ago, and it's still true today. Someone asked whether or not you can actually use the Grab credit and debit cards on through Apple Pay. And even up to today in 2025, this is still not possible. And I feel like they're really, yeah, they're really missing out on such a low hanging fruit that can really drive up adoption of their products, because it has been years since they launched their card program. So I really am confused as to why this hasn't been set up. And I'm not too sure whether anyone has asked management about it in the earnings call, but I don't really see anyone asking it, because I presume perhaps maybe people never realize that, the cards that they launch are not available on Apple Pay. And so, speaking personally as a consumer, because their cards are not on Apple Pay, despite me having one of their cards, I don't actually use it at all. It's just sitting there because I invested in Grab. I wanted to try out their product. But if you look at the revenue as well as the growth rates of the financial services platform, they are actually doing pretty well. $84 million as of revenue this year, and their loan portfolio grew from 397 million last year to 708 million this year, which represents a 78% year-over-year growth. And then on top of that, you also see customer deposits double from 730 million last year to $1.5 billion in Q2 of 2025. Okay, this is over here. This is something that they mentioned during their press release of their earnings, right? 730 million in the prior year to 1.54 billion this year, which is up from last quarter. Last quarter deposits stood at 1.43 billion dollars. And so what you're seeing here is that despite my concerns, the financial services aspect of their business is still growing and growing well. And I think, in part, the reason why I have this irritation is because I use Apple Pay very frequently, but perhaps the members that they're going after are not necessarily always the younger cohort of people, because some of these gig workers could be the older folk within the economy. And so because of that, they are not necessarily as in tune with using their cards on Apple Pay. And so even without this feature, they're still able to grow their business at a fairly healthy clip. And overall, I do think their financial services business is accretive to the overall Grab ecosystem, because it allows them to lend to their partners easily and to be able to help all these small business owners. And I think especially if you have the cash flow data of these small business owners, it is easier for them to underwrite the loan for these business owners and perhaps even give them a preferential rate. However, like I said, this particular vertical of their business is not yet EBITDA positive, and they have said that we can expect this segment to turn EBITDA positive in the second half of 2026, which means about another 1 year from now, right? And I think that when that happens, we are going to see their margins expand even further in the back half of 2026. And so from the way that, Grab's management team have really run their business, you can see that this is a management team with incredible foresight. And I think this is definitely proven when you take a look at their GrabX event, where they launch a couple of new products. And you can see in the most recent earnings, when they were replying to an analyst, that a lot of these products are actually growing faster than the existing products on their platform. And in just a number of months, the new products that they have launched during these GrabX events has actually made up 1/3 of total delivery GMV. So this really shows that the management team is in tune and in touch with the sentiment on the ground, and they're able to launch products that their consumers enjoy, their consumers use, and that's why it can become such a big portion of delivery GMV in just a matter of months. And I think apart from being a management team or a company that is highly competent, they are also a management team that is very mission focused. You can see that they really care about the people within their ecosystem and helping them make their business successful, or to at least make earnings from the gig economy. And so basically what happened is that if you followed the news recently, you would have seen that the Grab CEO, Anthony Tan actually visited the family of the deceased delivery driver. And I think on top of that, what Grab has done even further than that is to actually enable people from all over Southeast Asia to make use of their platform to donate to their Indonesian counterparts. And so the feature that they're using is this feature over here called 100 plus city deliveries. And what this is that it allows you or allows me from Singapore to order food in Indonesia or order groceries in Indonesia and deliver it to the driver. So you basically put a note over there and to tell the driver, hey, I'm buying this for you. I really want to help you out. Unfortunately, I'm so far away. This is the most I can do for you. And yeah, you can send a note over there to the drivers, and they actually have documented some of these drivers actually receiving gifts from people overseas. And I think with this, you can really see where the vision and the mission of the company is at. They're not just out there trying to maximize their revenue and profitability. They really are trying to create an ecosystem where they can enable small businesses to succeed, where they can enable people in the gig economy to succeed, right? And I think this is something that is actually worth doing, especially for the region, and to basically raise the whole economic status of people within this Southeast Asian region. But since we are talking about Indonesia, I think it's only fair that we end off this segment by talking about the possibility of a Grab and Gojek or GoTo merger. Now, I think a lot of people are excited about this, but if these two companies merge, I believe Grab would then have over 80% of the market share within Southeast Asia. And then I think there will be definitely concerns about Grab being a monopoly. So because of that, as well as certain regulatory hurdles from the Indonesian government, I do think that any potential deal might be complicated, and it's likely going to be Grab having a larger stake within Gojek, and then helping them or incorporating part of their businesses into their business and not take over the entire business. But we'll really see how that plays out over time. And I think what's important from here is that how we actually take all this information and put it into our valuation. So like I said, this is actually taken out from their 10K. I just want you to know over here that you can see the gross merchandise value, or the GMV, is the operating metric representing the sum of the total dollar value of transactions from Grab's products and services. And the on-demand GMV, which is what we are focusing on because this is what Grab tends to report, is the operating metric defined as the sum of mobility GMV as well as deliveries GMV. So when you see the words on-demand GMV, it's basically a combination of their ride-hailing platform as well as deliveries. And so with that, let's dive into the valuation. And so with that, let's take a look at how this Excel file actually works. So what you're seeing over here is we're starting by to understand the business from the most key metrics, which is users on the platform. So over here, what you're seeing is this metric known as the monthly transacting users, or short form MTUs. Now, this has grown in the mid-teens range over the last couple of years, or last couple of quarters. And this is a growth rate that is actually very sustainable, right? So on top of that, they also track their on-demand GMV, which is, like I said earlier on, a combination of both their delivery as well as ride-hailing business. Again, this is also growing mid 10% range over the last couple of years. And in the most recent quarter, this came in at a 20% year-over-year growth. So with these two numbers, we actually are able to get the amount of gross merchandise value per user every single month. Now, I think what is important over here is that you have to understand that this is not just me saying that this metric is important. This GMV per monthly transacting users is a metric that the management of Grab actually track and report in their earnings presentation every single quarter. And for me, that is how I'm actually projecting out future GMV. I'm going to project out how much GMV is actually generated per monthly transacting users. And then from there, we can get the overall GMV. Now, why do we need to know the overall GMV? Very simple, because we're going to find revenue as a percent of overall GMV or on-demand GMV, right? So before we go into the revenue aspect of the model, I just want to take a look over here. Financial services growing rather healthily in the last couple of quarters, 85% growth, 70% year-over-year growth, 81%, 64, 55, and then now back up again to 78% year-over-year growth. So like I said, their financial services side of the business seems to be doing well. I have very subjective concerns over their partners, but apart from that, it's good to see the business doing well. Now, the third thing that you're seeing over here is the incentives. Now, why am I tracking the incentives? Because the incentives that they use, partner incentives as well as consumer incentives, are levers that Grab can actually pull in order to gain market share. If they feel like, they're under pressure from certain competitors, then they're able to do that. But this, if you look at the numbers that are being presented over here, you can also see that it's going to be very hard for competitors to compete in the same space. Like in Q2 of 2025, you take a look at the numbers here, they handed out $239 million in partner incentives and $307 million in consumer incentives, overall spending around $546 million in incentives. And that means should any competitors want to enter into the space, they need to be willing to burn $500 million in incentives in order to compete with what Grab has, which ultimately becomes a moat for the company. Now, before I go on, I just want to show you the couple of graphs at the bottom over here that are fairly interesting. I think this graph over here, these three graphs are actually the most interesting of all the graphs. Now, the first one that you're seeing is the gross merchandise value as well as the relationship with the monthly transacting users. So you can see the GMV per user slowly has creeped up over time from the $80 range, now hovering close to 120s. All the while, the monthly transacting users are increasing, right? So at the same time, if these two increase, you can actually see an exponential growth in their revenue. Now, secondly, in terms of the growth of their gross merchandise value, their GMV, you can see that for a period, they actually declined, which was why their stock price declined as well. But over the last couple of quarters, since Q1 of 2023, they have actually managed to ramp this up, and this is back in an uptrend again, although still slightly volatile in the recent quarters. Now, and then this is perhaps one of my favorite graph in the whole earnings, which is the GMV and incentives. I believe I've shown this to you earlier. And so you can see the amount of incentives actually fell while the GMV still continued to grow, which shows that consumers as well as their partners enjoy using their platform, find value in the platform. And so this 10% in terms of incentives being paid out is a very sustainable number. And as the GMV grows, just by virtue of growing the GMV, this 10% will become a larger and larger number. And so every single year, their moat in terms of their incentives becomes bigger and bigger, and it gets harder and harder every single year for a new entrant to compete with them. Now, then after that, I'm going to show you this graph over here. This basically shows you the revenue of Grab for the last couple of quarters. Let me pull this graph slightly bigger so that you can see. Okay, I just realized the screen here is rather small. Let me zoom this in. So what I want to point out to you over here is that you can see this orange line represents revenue as a percent of gross merchandise value. Now, when Grab first came public, right, this number wasn't very healthy. It dropped into the single digit range. And I think a large part of that is because they were spending a lot of that on giving away incentives. But over time, you can see that Grab's revenue as a percentage of GMV has slowly increased and now basically steadied out in the 14 to 16% range over the last few years. And I think this is a fairly stable number. This is how we are going to predict or to project out our revenues ahead. Right, so we are going to find the GMV and then we take 15% of the GMV as revenue. So as GMV grows, revenue will actually basically grow accordingly. And then over here, you are able to see over the last couple of quarters, they have turned EBITDA positive as well as net income positive, although their profitability they is still fairly nascent, I would say. And so because of that, this is not actually something I'm paying too much attention to. Of course, I want them to continue to keep up the profitability, but I'm not too concerned over some of the volatility and fluctuations that we see over there. So with that, because Grab is actually a cash flow positive company, I want to make the disclaimer that I think that they are still a very young company in that sense. And I don't think using a DCF is the best way to value the company. But since they have shown cash flow positivity over the last couple of years, I think it's only fair that we run them through the DCF. So let me zoom this in for you. What you're going to notice, first line, revenue, okay, 12% year-over-year growth. And then let's say this slowly increases and to 15%, and then basically steadies out for the rest of the decade, growing at only 15% top line number for the rest of the decade. Now, then over here, what you're seeing is the cash flow from operations. Previously, they were at around 27%. This year, currently on a trailing 12 months basis, they're coming in at around 21%. But let's say they increase this to 25, 27, and 30%. Now, why am I projecting an increase in cash flow from operations? Very simple, because I think they are burning a lot of cash right now when it comes to the financial services side of the business. And as that segment actually turns to profitability, I would presume that they'll have to burn less cash on things like marketing and all that. And so because of that, I expect that segment of the business, as well as once it turns positive, to contribute to profitability and drive up their cash flow margins, right? And finally, capex. This is rather straightforward. You can see the pattern over here. It's around 2 to 2.5% over the last couple of quarters, and that is what we are assuming for their capital expenditure going forward. And using the amount of cash that they have on hand, less the debt that they have, I think at the end of the day, you can see that with the shares outstanding, if these assumptions are true, Grab should be worth around $10.26 using the perpetual approach. Now, I'm going to show you fiscal AI, and then you can take a look at the EV to EBITDA and how I actually ended up at that number over there. All right, if I go to industry, let's see. Okay, over here you can see I'm basically comparing the EV to EBITDA between C Limited, Lyft, Uber, and Grab. So of course, Grab is the highest right now. I don't expect that to always be the case. And if I take the average here, the average EV to EBITDA is around 55 times. So if I go back to my Excel file, you can see that I have decided to use a number that is actually even less than 55 times EV to EBITDA, even though 5 years from now, it's actually safe to say that Grab wouldn't have been finished growing yet. They would be a little bit more mature, but they would not have finished growing. But even then, I've chosen to use a slightly more conservative multiple to see where that leads us. And so back to the Excel spreadsheet, if you take a look at the multiples approach, what you will notice over here is that the EBITDA margin stands at around 21%, and the EV to EBITDA multiple that I am using is 40 times, right? So which is much lower than where some of the other companies within the space are currently operating at. And so even with that low assumption, you get a share price of around $15.66. Now, if you take that in aggregate, you end up with an implied share price of $12.96. Now, the margin of safety over here, I am only giving 10%, despite this not being a US company, for the very simple fact I live in Singapore and I use this product nearly every day. So I feel, pretty safe understanding the product, understanding the business model. I don't think this is a company that is poised for any sort of exponential growth like Palantir. I do think $10 in 2 to 3 years' time is actually quite doable from here. And so what you can see is that based on today's price, today, for the first time in a long while, I think definitely new 52-week highs, Grab stock actually closed at $6. And so from the $6 range, then there is around a 94% upside from here. However, if you just go back one day, right, to Thursday, then actually there's more than 100% upside, because with a 10% margin of safety, the price target would be around $11.66. And so with that, really, I think the price target of the company really depends on your risk tolerance. If you are unsure about the region, like for me, sometimes when I invest in China, I like to give a larger margin of safety because I am unsure about the dynamics of the region. And if you are someone that is perhaps not in the Southeast Asian region and you feel uncomfortable with just a 10% margin of safety, feel free to go even further, 20% margin of safety. Even then, that takes it to $10.37. And just a day ago, that would still have given you around a double, right? Nearly 100% upside, because it was at $5 or so at the end of Thursday. And so with that, I think, it's safe to say that Grab is fairly undervalued at the moment. However, it's fairly undervalued only if you believe that it can continue to ramp up its growth, it can continue to sustain its growth while ramping up its profitability in the quarters ahead. And I think with the financial services aspect of their business turning profitable in the second half of 2026, that is definitely a very high likelihood. And so with that, we have come to the end of the video, and I will see you in the next one.